Thank you for spending some time with us on our Market Matters series. Turning to the agenda for today real quick, we'll talk about the COVID-19 fact pattern. We still want to make sure we're addressing some of the updates around that. We'll talk about the economic and investment implications. And then finally, we'll touch on the special topic, which we had a lot of interest in, which is opportunities and risks in commercial real estate. And just for everyone's purposes, that special topic is really more for educational purposes, but we do actually have some good insights on that front given our activity in those markets as well. So let's get started. So this is a similar chart we've shown in prior weeks, but I do think it's important to continue to look at where each country is within their relative cycle of this infection. This is actually brought to you from The Economist, and you can see that it does appear this week or shortly thereafter, maybe next week, the US will be reaching a peak in relative infection per person or per capita. And then, of course, good news is that most of Europe, not all, but most of Europe is nearing their terminal point where they're on the downslope and firm recovery mode. You can still see other parts of Europe like Sweden, the UK, and France nearing the late accumulation stage. And what's not shown on this chart, which there were a few countries from last week, but what's not shown is the emerging markets. Emerging markets, particularly South America, but also Africa for that matter, are just starting getting into the acceleration and late accumulation phase. Most of them around in this area, just given that it took the virus a lot longer of time, COVID-19, to get to those continents. And this is what we were talking about nearing the peak, and this is obviously, I think, very positive news. You can see this is just data out of Georgia, but it's very similar in other states that surround Georgia. New York would have a similar feel to this as well. You can see on the left-hand side here, you can see the number of cases in Georgia, the new cases on a daily basis. So you can see the peak actually happened a couple of weeks ago, or maybe a week and a half ago. You can see the number of new cases now is almost dropped to 0, which is really, really positive. And then, of course, the related deaths, now that we've got the folks that are infected, deaths are on the decline as well too. And this is, again, very similar to other areas around the country, but it definitely, I think, is proof that we are on the back end of this. So looking at an estimated timeline for returning to work, those of us that are working at home full-time are all very excited about this potentially, but we obviously don't want to get too preemptive because the second wave is probably looming off in the distance somewhere. But you can see, for orientation purposes, this is from Morgan Stanley. They put this together. Here we are today, April 20th. You can see the arrival of antiviral trials starting, capacity getting to 1 million a day tests, which is a key variable starting in the better part of early June. Serology testing, antibiotics, things of that nature. Public health departments would be theoretically fully staffed by then, because this is going to be probably a longer or a more permanent fixture within most of our health departments, which I think is a good thing to keep track of. This virus just brings forth the necessity to have such staffing. And then, interestingly, that Morgan Stanley is estimating that the first wave would be able to return to work by early June. And obviously we've got a number of different milestones to hit before we get to that point, but it does provide a pathway forward, which I think is really important for everybody to look forward to. And phase 1 would be things like only having a certain number of people in the office at one time, those that have gotten tested potentially, and then the tracing aspect of all of it. Phase 2 or wave 2 would be a more full office potentially. But again, even companies like us, Gratus, we're grappling with how this should look like and what this should look like, as we move forward, into the future. So it's probably going to involve a lot more remote working for us as a company, just going forward. And I think that's not necessarily a bad thing. They are anticipating schools to reopen around Labor Day. So, this will be a positive dynamic if we get schools open. I mean, I know there are a number of folks in the higher education community and the college systems that are really worried about not being able to have fall semesters starting at the same time that they normally would, because that would, I think just jeopardize the financial situations for a lot of colleges that might be on the cusp of financial issues. And then you can see, potential vaccine dates for healthcare workers, potential vaccine dates for the remainder of the population. So I think this is an interesting kind of exercise to go through, because it's critically important that if we are going to have this recovery we're all looking forward to, we need to get people back to work and in a smart way. And of course, these are just some notes that we came across over the last couple of weeks that we thought were interesting to note. Georgia governor yesterday decided to issue a press conference stating that as early as this Friday, a number of different types of businesses would be able to reopen. So those would be, I think, things like healthcare or gymnasiums, nail salons, hair cutteries, things of that nature. And that in the weeks to follow, that there would likely be other businesses to reopen. This may be a little bit preemptive based on, what we currently have as, testing and tracing abilities, but, Georgia's pushing forward. So is South Carolina, I believe so is North Carolina and Louisiana. Other items that we noted on during the week, and this is what I was talking about, some upside surprises to the regulatory aspect of the drug approval system. Novartis, which is the manufacturer of that malaria drug that's been apparently very effective at treating COVID-19, just got fast track approval to undergo testing or test trials. When normally that would take weeks to months. This occurred in a matter of days since they applied. And then just as maybe another upside surprise in the way that maybe artificial intelligence is being used, this refers to the fact that COVID-19 can now be diagnosed in chest X-rays in a matter of seconds with 98% accuracy. So not that we have any radiologists have to worry about their job, but I think we should expect more volumes to occur with chest X-rays, and that if you have AI solutions getting those types of accuracy levels, that's usually a really good thing. And then there are probably going to be multiple other ways in which AI will be utilized during this whole ordeal. So I guess the good news is that businesses are seeing a way forward from an opening standpoint. Technology is certainly playing a role, and even companies like Abbott are developing tests right now that can have results back to people within a matter of minutes. So that's all very, very positive. Turning to the economic and investment implications, here you may recall there are some similar comments to last week, but we've updated most of these since the last time. We are still looking to rebalance accounts again after having rebalanced them when the S&P was at, I think it was at 2,300 or 2,200. We'll be looking at rebalancing accounts somewhere between 2,900 and 3,000 currently today, with the market down. I think now the S&P is around 2,750 or 2,800. And what this would involve would be trimming equities and adding to bonds or alternatives. We're also continuing to recommend holding short-term liquidity needs in cash, and that would be 6 to 12 months of living expenses. And that's the reason that we're estimating that is because this is about as long as we're estimating it will take to get through to the end of this recovery phase on the upside. Inflation hedging is becoming more of a long-term priority. That's certainly, I think, top of mind right now for our investment team, now that we've got upwards of $10 trillion being dumped on the economy by both the Federal Reserve and the federal government. And if there's new money being created to help support either lifestyle that didn't exist prior, then that certainly just runs the risk of being inflationary. On the equity side, we are monitoring a lot of the earnings coming out, and I think earnings season will be driving relative performance recently over the near term. And I'll go through some of that here in just a minute. Active management right now is really showing through in spades. We have a few strategies, particularly on the large cap equity side, that are having really amazing relative positive years in some cases relative to their index. And I think this is the type of situation where active management can really show its value, if you will. Whereas, and the reason that is, just briefly, is because dispersion now between stocks, so the return that one stock has versus another, or industry sectors versus other industry sectors, are really wide. And by that I mean, so take information technology, through last Friday was down as a sector, I think it was less than 1%, whereas you had the energy sector down over 50, or the industrial sector down over 30. And that dispersion, that difference between one sector versus the other, is really positive for active stock selection. And we think that's only going to get more important. Fixed income credit markets are presenting attractive risk rewards, although not as attractive as they once were a few weeks ago, but still opportunities to pick up nice yield enhancement over Treasury in a lot of higher quality sectors like corporate bonds or even government-backed Fannie and Freddie securities. And then finally, you all have probably noticed for the last 2 days, the commodity energy markets are showing signs of some pretty extreme stress. And that also has a way of building the pathway forward for longer term inflation risks. So we definitely want to make sure we're keeping an eye on what's going on in the commodity markets. So let's turn to the S&P for a minute, because now that we have a few reports out, we've got 1.5 weeks of earnings that have come out so far this season. What's been the effect? And this is important because we did have about a half of the quarter, starting in mid to late February, being impacted by COVID-19. So if we think that's a decent measure of what's likely to come in the coming quarters, then this might be a decent proxy for how to view what's going on in the markets. And again, it's a tale of two cities, because for reference, the blue bars show not only year-over-year revenue growth in the S&P, margins, and earnings, but also broken out by sectors. So you can see here for the year-over-year, estimated the revenue to go down less than 1% from first quarter to last year to first quarter this year. Margins have contracted by about 12 basis points, 12.4 basis points year over year. I'm sorry, percentage points. And then earnings are actually contracting somewhere in the neighborhood of 14% or 15%. You can see what I was talking about by sectors. The story is very different. So technology, you're seeing positive year-over-year revenue growth, margins being impacted a little bit, but also positive earnings growth of about 1.5%. Non-cyclicals, this would be things like healthcare, showing positive year-over-year revenue growth of 4%, margins being impacted a little bit, but also still positive earnings. And then what's being really impacted by the slowdown in COVID-19 are things like financials, which tend to be very economically sensitive, as well as cyclical companies like materials or industrial companies. You can see the massive hits of earnings those have taken already, down 28% for financials and about 40% for cyclical or industrial companies. And financials is an interesting one to keep an eye on, because if the banks are being more restrictive with lending, that in and of itself may cause the recession to be worse. But most of this earnings drawdown has to do with the fact that companies like JP Morgan and Citigroup are setting aside billions of dollars in anticipation of loans that they think might go bad over the next 6 to 12 months. So it's a tale of two cities, if you will, which is we want to be in the cities that are on this side of the chart and not in the cities on this side of the chart. Looking at large companies versus small companies, as you may recall, from our prior presentations, we have had a 0% weighting, if not substantial underweight to small companies for the better part of the last 10 years in our benchmark portfolios. And you can see, I think the GFC gave us a good idea of what would likely happen to earnings in small companies versus large companies. So this was why we had no exposure up until even up until February of this year. And that is, when you hit a significant downturn or recession, earnings in small cap tend to get hit a lot harder than large caps. So the Russell 1000 is a large company index, largest 1,000 companies. The Russell 2000 is a small cap index. It's the next 2,000 largest companies after the Russell 1000. And you can see, Russell 1000 companies went down about 35%. 2,000 went down 45%. But they did, and this is important, they did recover much faster once the recovery took hold. And you can see where we are today. This is from February 28th of this year to, I believe this was April 17th. And you can see already Russell 2000 company earnings are down 35%. S&P or Russell 1000 company and earnings are down 15, which also would help explain some of the performance that we'll see on the following pages. But anyway, we are not in any small cap right now, thank goodness. But we will likely look at it once it appears that we're turning a corner from a growth perspective. This is the graphical depiction of year-to-date return numbers by each of these various subcomponents of the equity market. The red line, of course, is the S&P. The blue line is the Russell 2000. That's the small cap index. The green line is the international developed markets, and the pink line is the emerging markets. You can see emerging markets and developed international are roughly down the same, about 20% or so. Russell 2000 down close to 28, but the S&P is really punching above its weight, I guess, for lack of a better term, at down only around 12. And so this is information through yesterday, so it's not quarter end, it's through yesterday. And you can see the question, of course, is have we gone too far too fast and off of the low, which at one point was down 31, now we're only down 12. Isn't that setting up for, maybe a pullback or of some sort? And I would say, that's probably the most likely course of action, over the next 3 to 5 months or so, is that it would be unusual if the S&P didn't at least get back close to the lows of March of this year, and then from that point forward go into some sort of trading range until the economy and earnings can start to recover from the drawdown. But again, that's not to mean that we should be selling out entirely. That's not to mean that we should consider any drastic reductions in our equity sleeve, because within each of these sleeves there will be winners and losers. And I think, particularly to the companies that we follow or have in our proprietary portfolios, we're seeing some really positive performance differential across some of those companies that are, in fact, thriving in this environment right now. This is the upcoming week, or for the week of April 20th, which is this week. This is the slate of earnings that are due to be reported by day. And we've just highlighted the ones that we think are important because, most of these are Dow component names. Actually, all of them are. But there are also some important companies to give us some idea of what's going on in other sectors of the economy. So, for example, Netflix is reporting earnings this afternoon after the bell. And that'll be really interesting to see how much people are actually streaming versus what our expectation was. Because recall, we do own companies like Amazon that have streaming services that would likely experience a similar benefit if the earnings are. But looking at IBM and Coca-Cola, their earnings were down just slightly year over year. Both are withdrawing guidance, but interestingly, both are maintaining their dividends because they've got the balance sheet and the stability in their business models to weather the storm, if you will. Same thing with Travelers. Travelers is one of the biggest insurance companies in the United States. They did have to take some charges relating to catastrophic loss around weather events and some other items. But interestingly, Travelers raised their dividend 4% today. And believe it or not, there's actually been a number of companies in our portfolios that have been raising dividends. Costco reported last week, they raised their dividend 6%. Johnson & Johnson raised their dividend 6% last week as well too. And other names like Procter & Gamble raised their dividend 6%. And in future market matters, I think for the next one, we'll go through a deconstruction of some of the earnings and what's going on with some of the dividend payments, because that for us is a key metric or leading indicator of what companies we would likely want to invest in longer term and even through this period. But certainly we'll be looking at, Dow, there's one of the biggest chemical companies in the world, to see what chemicals demand looks like. And then of course, American Express will give us a great look into how the American consumer is adapting to this and spending patterns and things of that nature. So we'll be updating you guys with some of those data points next week. Looking at fixed income, This is obviously, a part of the portfolio that's been a bit of a challenge, I think, this year, because the only part of the portfolio that's done decently is the aggregate bond index, which is the one here in red. The aggregate bond index is 90% U.S. Treasury and government agency bonds, with very little corporate exposure or asset-backed security exposure. The blue line is the corporate bond market. And you can see that the drawdown that had back in middle of March, only to recover back to about a positive return this year. And because of this dramatic return that it's had over the last few weeks, we were able to capitalize a little bit with some of the individual bond purchases. But it looks like from here, we're almost back at levels we were pre-COVID crisis. And in that way, it does make it challenging to find strategies that are demonstrating a significant amount of value right now on the corporate side. But certainly if you're picking individual bonds, that gets to be a little bit easier. On the high yield side, it looks like the high yield bond market is not necessarily buying what the Fed is offering, because the Federal Reserve, if you recall, last week decided to support what they call fallen angel companies, and those were companies that previously were investment grade in March, but now are junk rated. And it looks like the high yield market is just not buying that the Fed is going to be buying a whole lot of high yield bonds right now. Same with emerging market bonds. Now, the good news is for us, we don't own anything in high yield or emerging market bonds. So we, again, just to reiterate, that that juice is not worth a squeeze, because coming into this crisis, high yield bonds up here were showing some of the smallest or lowest yield levels in absolute terms they have for the past 30 years. And we thought, well, just the risk is not worth the return potential at this point. We still don't think it's really worth it here, because I suspect there might be another leg down for high yield if we do get into this double or market retesting the lows scenario. And just now that we've got some data points coming out around March, I did think it was important to share some of that with you, just so you have an idea, an understanding of how we're thinking about things. So this is retail sales. This is the Census Bureau puts out, or the Bureau of Labor and Statistics puts out these data points every month. And it's really interesting because you can see segmented out retail sales all mishmashed together. It doesn't really tell you a whole lot. But when you start pulling it apart, that's really where you get to see some interesting trends. So general merchandising stores, this would be stores like Walmart. I think even Amazon is rolled up into this general merchandising store. And you can see what's happened is Target would be another one. Sales have actually gone pretty decently up because of people getting more toothpaste and toilet paper and some of the essentials from some of those stores. Interesting also is building materials and supply. I was telling our investment team that, and it holds true, the more you stay home for either teleworking or for whatever reason, the more you want to improve your domicile, I guess. And Home Depot, Lowe's are all reporting nice, improved. Ace Hardware all reporting nice increase in sales. But what's not doing so well is exactly as you would expect. And it would be things like mall-driven stores, like department stores. You can see the trend that started back in 2005 is now really accelerated to a crisis point from a lot of malls. And if you read, or if you listen to mall owners or developers, you would understand that they already saw some of this coming and that a lot of malls needed to close down prior to any of this, COVID crisis. So that's just accelerating some of that drop off. Macy's, Dillard's, Nordstrom, all sharing, updated sales numbers, and it's not a pretty picture. Sports, hobbies, bookstores, music stores, again, similar trends that had been, put in place starting in 2016 have now really fallen off from that perspective. So, sporting goods stores, Dick's Sporting Goods being the one I could think of that comes top of mind, because sports aren't being played anymore. There's no reason to go buy sporting equipment. So that makes total sense. Hobby stores, things of that nature, it's just going to be a direct impact. So I guess my point in showing this is that we want to be attached. If we're investing in individual companies, we want to be attached to companies up in these areas that, have, good trends attached to them that can thrive through this whole ordeal versus those trying to, bottom fish in companies that are distressed right now. So that just maybe gives you a little bit of insight as to where we're looking for opportunities versus where we're not. And then this is an interesting one from the labor market. You can see weekly jobless initial unemployment claims over the last 4 weeks. This is just a staggering number because, first we reported this big jump in March. It was 3 million, followed by a 6 million, now down 5. So the trend is decelerating, which is good. But that also means that there's roughly 22 million people unemployed right now in a very short period of time, which is why that stimulus was so helpful. And I think it also suggests that, or another interesting data point is all the jobs that were created from 2009 to 2020 basically were evaporated over the last 4 weeks. Now, that's not to say that, again, we should be scared of that statistic. It just means that there's going to be a significant amount of reconfiguration in the economy on the other side of this recession. And then this is that chart I was talking about where this is the front month future for crude oil here, and this is a US index. It's getting some decent follow through today. But, crude oil was down to a negative $37 price, which doesn't make any sense, right? I mean, how can you have a negative price for oil? Well, it's really just a feature of the futures market, which means that if you, the way the futures market work is if you are an owner of supply and you want to deliver that commodity future for settlement based on a future date, then you have to deliver it to a certain point or place in the country, like Cushing, Oklahoma is where most storage is. If those storage bins are full in delivery points, then you've got nowhere to deliver your crude and you have a problem on your hands, which is why you see this dramatic pricing. Now, the interesting news or interesting piece of this is that if you look out in the futures market for commodities to October, November, December, those prices haven't changed a whole lot, and it's around between $30 and $35 per barrel. But this was just something that was really crazy to note yesterday and really has all to do with this whole storage issue that we've got going on right now globally. And then this is just, I think, one of the reasons why we think that markets can trend sideways for some time. It's not too dissimilar between, the periods of 2000 and 2010, where actually the S&P traded in a range for the better part of 10 years. What we're showing here too is, in and around pandemic periods, this is the Spanish flu episode, and even before that in the 1800s, markets can be range bound for quite a long period of time. I mean, we're not expecting the market to be range bound for 20 plus years, but certainly we would expect as the economy recovers and earnings recover, that there be a kind of choppiness to the market, or the S&P for that matter. And that actually is our base case scenario. We'll have kind of a choppy market for the next, 6 months or greater. Now, again, that is really good news for active stock pickers, because if you are buying things at, good prices when the market's choppy and they rise to your fair value, you can sell them and then find other things that work for your portfolio. So we have actually seen in our portfolios, our proprietary strategies, a bit more turnover this year than we have in other years. And that's primarily because prices are moving around a lot faster than they ever used to over the last 10 years. And we're taking advantage of a lot of those opportunities. So here are just a few key takeaways. One is that the economic news flow will continue to remain negative until the mortality rate turns lower definitively. And I think that's certainly starting to show up as I demonstrated with some of the Georgia data. Sideways market is our best estimate for with a retest of the March lows potentially sometime in the next 3 to 6 months. Our strategy, especially for those that are looking to coming to us with cash or with new portfolios or securities, is to average in over a 6-month period. That way, we're getting a good slice or opportunity at every time we're making a buy or sell. And then earnings will be the catalyst on a stock by stock basis. And so this is definitely, I think, turning into a stock pickers market as opposed to a index driven market, because with dispersion so wide, we can find opportunities pretty well with such wide performance dispersion. So that concludes the prepared topics. This is just a section that I've thought would be interesting to touch on, because we are active as a firm, Gratus Capital, in private markets. One of those markets is commercial real estate, and commercial real estate does appear to be one of those areas that will be uniquely impacted by COVID-19 in a number of different ways. So I thought I would just touch on a few dynamics we see going on right now where we're looking at opportunities, and then we'll conclude it with some questions. So this was a chart put together by a real estate manager that we know pretty well, across their portfolio, where they're seeing risk from an operational impact, historical sensitivity to recessions, near-term pricing risk. How does the near-term pricing risk relate to the GFC? And then longer-term risks relating to COVID-19. So I guess the good news for us is, as an investor in these markets, we actually have concentrated most of our allocation, our equity capital, in private markets to the lower risk, longer-term areas, and that's just by coincidence. We didn't trade notes before this discussion, but we do find things like apartments attractive, because apartments, everybody needs a place to live. Home ownership is going down, or has been going down, trending lower for a variety of reasons, and we still think that's an interesting place to be looking for opportunities. Medical office, I still think that's a great opportunity to look at, because if you think that more testing is going to need to be done longer term, demographics as well are driving increased utilization of medical facilities. Self-storage just tends to be one of those areas of the market people forget about, but is actually really one of the most recession resistant, because if you are downsizing because of unfortunate situations or circumstances around a recession, you're moving into an apartment and you need a place to put all your stuff. So that is a really interesting place to be looking right now. And then industrial, if you think that Amazon is going to be delivering more packages to your house than they did in the past. I mean, I'm just using my family as a proxy. The Amazon ferry probably shows up twice a day now. Used to be once a day. We do most of our shopping through Amazon and places like that online. So I think that's a pretty safe bet that industrial will see enhanced demand. And then other areas that we haven't really been looking at, certainly malls, definitely going to be challenged longer term. I'm sure there's going to be some people that'll do really well in this sector, but the price has to be really right for that to even be considered for our purposes. Office is one of those question mark areas, because we do have some exposure to office. And the question, of course, is, are companies going to be requiring as much office space as they once used to, given that now we're also accustomed to working from home and working remotely, or even places like co-working spaces are becoming more popular? That's a big question mark. I would say we're not necessarily looking very actively in that space, but it's certainly interesting to see what opportunities are out there. And then senior housing and lodging, those are, I think, both really treacherous places to be active on the equity side. Could be really big hits if it's a single asset in a good, well-located area. But for our purposes, it's still a bit on the risky side on the equity. Now, if you're lending to some of those areas, then that might be a better way to go. So interesting, there was another survey that came in from a rental aggregation system. So this particular company receives payments for, not Heitman, but it's a software company, I forget the name, but they track roughly 19 million units across the United States. And what you're seeing in front of you is rent collections by month. So you can see what April was in the month, roughly 85% of all rent was paid versus the expectation, which I thought was surprising to me. That was a little bit lower than I would have thought. I would have thought it'd been closer to 90, but that's not the case. Fast forward to March, you're at about 82. And then in April, that declined to about 75, roughly. And that actually, I think, is one reason why we do find apartments so attractive, is that even when you have mass layoffs or mass people losing their jobs, they still need a place to live. And, apartments tend to be a good, safer place to allocate capital. And then I just thought this is an interesting chart. Some real estate investment trusts have started to report earnings, and they are giving some really interesting portfolio visibility into what's going on with their tenants. And this particular one, Spirit Realty Capital, I know it's a little bit hard to see, so my apologies, but Spirit Realty Capital is a diversified real estate investment trust. And they have a number of different areas in their portfolio that they have tenants in or own buildings in. And the ones I wanted to focus on, so just the way to read this is, you've got your actual percentage of the portfolio that's made up by each of these categories. You have rent deferral requests by category, number of tenants that have asked for deferral, and then whether they're essential or not essential. And that can be a little ambiguous, but you can see most of the rent deferral requests are occurring within the restaurant, quick service space, casual dining, as you might expect, movie theaters as well. 100% of those tenants are asking for rent deferral or defeasement. You've also got, health and fitness centers, again, kind of the LA Fitnesses of the world. Those are certainly, by mandate being required to shut down. So I guess that does have an impact on the revenue stream for sure. But look at what's not being impacted, or those that are not asking for rent deferral. Those would be things like drugstores or pharmacies, grocery stores, professional services. And I don't know exactly what that means. I'd have to look in the footnotes, but dollar stores, certainly if you think that consumers will migrate down to a lower price point in challenging times, dollar stores will do really well. Warehouse clubs and super centers, there'll be things like Costco's or BJ's Wholesale. Logistics and distribution centers, no one's asking for rent deferral there. And then office supplies, pet supplies, ag, those all tend to be pretty essential pieces to the economy. So I just want to, we're not making any recommendations on this particular webcast, but we do wanted to point out that there are some really interesting opportunities in some of these sectors that we just noted on. In that, while it might seem a little scary to be committing capital to private markets right now, I think there's, for patient capital particularly, it can be a really beneficial opportunity and area to enhance your portfolio return. So with that, I do want to thank you for your time. I'm going to move over to the chat feature right now to just see if there are any questions that I can run through and just see what's on people's minds. So let's see here. How can we obtain a copy of your slides to study further? Great question. Thanks for that. We will for those of you that would like a copy, just please reach out to either the info@Gratus Capital email or your advisor and just say, hey, I'd like to request a copy of these slides, and I'll certainly provide that to all the advisors to get out to you all in due course. So that should be within the next day or so. So another question was, does an increase in dividend yield mean more dollars, or is the yield effectively go up as the underlying stock prices go down? So when I was referencing those dividend payments, what I was actually referring to was the actual dollars being paid by the company, by J&J, was going up 6% year over year. So if they were paying $1 per share in dividends, then they'll be paying $1.06 next year, if that makes sense. So these are actual unrelated to the stock price. It's just the dividend payment. So, but as you rightly point out, if you're buying J&J now ahead of its dividend increase, or if you're buying J&J as opposed to maybe a few months ago, your dividend yield is higher because the stock price is obviously lower. So hopefully that makes sense. Another question would be, how would you average in cash if it's a new account or a strategy? And this is a common we do have quite a few new clients this year, particularly as they've monetized business assets and things of that nature. So what we're recommending to all clients, and I've said this, generally as well too, is that, for anyone looking to get into their equity allocation, we would recommend getting at least half of the equity exposure invested now. So, if it's a 60-40 portfolio and 60% of that 60-40, it would equals, let's just for round numbers, call it 600,000. Then we would recommend, investing right now 300,000 to the market, because we don't know exactly which direction the market will go. But over the remaining 6 months, or over the next 6 months, average in the remaining 300,000 equally over 6 months. So usually we're picking, down days for the market or substantial down days for the market during any of those months. But that's exactly how we would go about getting new cash invested into the market. And then there were a couple of questions about particular stocks or specific stocks that we like to reference or have referenced. And I think what we'll do is, for the next Market Matters, two things. One is one update. I think next week we are going to have a guest speaker come on to talk either about the COVID crisis or about the political situation shaping up. And I think you'll be excited with the caliber of people that we're able to get as a guest speaker potentially. But if that's not possible, if the dates just don't work for whatever reason, I'll plan on running through a few of the specific opportunities on the equity side that we find very interesting right now. So more to follow on that. So be watching your input. So I do want to thank you for your time today. Hopefully you've enjoyed and found this information interesting. I will plan on getting this information out to the advisors here, hopefully by the end of the day today. And with that, I think we'll stop it there, and look forward to seeing you all next week. So thanks for your time.